The new Consumer Price Index report is out, and it doesn't look like there's any relief in sight from inflation and higher prices in general. For more on what those numbers mean for your bottom line, I want to bring in Michael Pond. He's the head of inflation research at Barclays. Michael, good to see you.
Michael, I bet you when you show up at a party, people grill you. Inflation research, what an interesting area.
It really is. And so let's talk.
These days it is.
Yeah. So let's talk inflation, Michael. The CPI up to 8.5% compared to what it was a year ago. Let's talk about the impact that will have on the average person, and will we see it trending upwards?
Yeah, so that's the highest reading. That 8.5% is the highest reading since we've seen on year-over-year headline inflation since December of 1981. So it's been a while since consumers have been experiencing this level of inflation. There is some good news in that most of that rise on a month-over-month basis, which was quite significant and a surprise to the market, was due to an 11% gain month-over-month in energy prices and about a 1% gain in food prices. Not that that alone is good news, but what we know is that oil has already come back down. Oil peaked at 120 on WTI in the middle of March and is now under 100. So consumers are already seeing some relief at the pump, with gas prices coming in a bit lower already, and that's set to continue to fall in the coming week or so. And then on food prices may stay elevated, but if we look under the hood on the inflation print, core inflation, so ex-food and energy prices, actually rose at a slower pace than was expecting. Consensus was expecting a decent print of 0.5 month over month, and it, quote unquote, only came in at 0.3. So still a strong gain relative to historical levels at about a 4% annualized rate. 4% annualized rate is nothing to celebrate, but the direction is. And we had been seeing more like 6% or above on the trend in core. So there does seem to be a slowing there. In particular, we got a big drop from used car prices. Used car prices fell almost 4% on the month. That's been a huge contributor to inflation over the past year, and there looks like there's some softness there already. And shelter prices didn't rise as much as what we might have feared. So, and it's important to remember that within CPI, it's rents that are measured, not home prices. Mm-hmm. So still rising at a higher than pre-pandemic pace, but not as much as feared.
But I have been hearing the R word, I've been hearing the R word bubble up, and you're one of those people that said it. You actually released a report prior to the Labor Department's report, and you said that the risk of a recession has actually gone up. Explain how that works. Why would that be?
Well, it has gone up, not to alarming levels yet, but the Fed is raising interest rates in order to slow the economy to try to offset some of this inflation pressure. The risk is that they go a bit too far because inflation is high and they might need to do some heavy lifting and slow the economy quite a bit to bring down inflation back towards their target of 2% on PCE inflation. Now, we don't think that's the case. Our baseline is that growth softens a bit from where it has been, and inflation comes down back under 3%, but not to the end into the end of next year. So we expect a gradual normalization, but there's certainly risk given what's going on in Ukraine, given what's going on continuing in pandemic-related supply chains, and now you have the Fed tightening. That increases the risk that we have a recession, although it's far from locked in.
So your analysis also says that rent inflation indicators are up. What is that doing to the housing market?
That's right. So if we look at private measures of rent inflation, they're up into the mid double digits, so into the mid-teens, that is. So if we look at a series from Zillow, for example, which is quite well known, that's up 17% year over year on a rent measure. Others are there as well. One from Moody's Analytics is up 15.6%. So when we look at the rent reading within the CPI, it's up much less, but still above the pre-pandemic average. So the risk is that some of these private measures end up being leading indicators for CPI, although with a low beta, and that we get a continued increase in rent inflation within CPI to up to 7%. I think there's a risk of that, even though our baseline is that it continues to run as it has at about a 4.5% to 5% annualized rate. So there's lots of risk out there. What that does is increase forecast uncertainty. Some of the pandemic-related supply chain issues we think should start to solve themselves and ease that inflation pressure. But at the same time, you have upward pressure from rents and now food prices with the war in Ukraine slowing supply of things like wheat, fertilizers. That puts upward pressure on the risk that food inflation stays high. So the Fed has to navigate these risks, which are clearly on both sides, both the risk of slowing growth too much or leaving inflation too high for too long, and that starts to become structural.
All right, Michael Pond, thank you very much.
Thanks for having me.